I am your host Priyankar Baid, and today I have a very special guest, Mr. Rajeev Kalambi. He is the General Partners at Cactus Partners.
My career has actually gone through several transitions. I mean, Louis Vuitton, everyone wants. But do they have the ability? Bird's eye view, a 35,000 feet above sea level view of what you're going to do.
Hello everyone, welcome to the latest episode of our podcast Unicorns versus Cockroaches, the podcast that celebrates the success and grit of bootstrap startups across India. I am your host Priyankar Baid, and today I have a very special guest, Mr. Rajeev Kalambi. He is the General Partners at Cactus Partners, and he represents one of the leading VC firms in India. Today we bring you the perspective from the other side of the table, how investors and VCs view funding. And our hope with this podcast is that you hear viewpoints of people who invest in companies and get that perspective too. Rajeev is a fellow ISB alumnus. He's had 23 years of experience in private equity, venture capital, and essentially from the financial world. Welcome, Rajeev. Happy to host you here.
Thank you so much for having me, Priyankar. It's a privilege to be here. Whatever little bit I've learned over the years, I can share with the audience, and I hope I can help them in their growth journey.
Thank you for that. And just to cover a bit about Rajiv's latest venture, Cactus Partners. So Cactus Partners is a fund which just did its maiden close of 650 crores and specializes in sectors like clean tech, environment tech, sustainability ventures, very focused on new age businesses, which will create impact in the coming years. Rajeev, it's very interesting to see that your fund is also involved in an Ayurvedic brand called Auric, targeting millennials. So it speaks a lot about your flexibility of covering the entire spectrum, right from clean tech to consumer tech. Now, I think, Rajeev, I'll kind of start the podcast with a question about your journey. You've typically been in private equity in the finance world, and what led you to launch Cactus?
Priyankar, I think my career has actually gone through several transitions. Post my master's in economics, I worked with a financial consulting firm for a little over 2 years. Post that, I set up the research backbone for CNBC in India. CNBC was young, emerging. I was part of the original founding team. We set up the research backbone for that. Post that, I have been a corporate banker. Post that, I moved to investment banking, where I've helped companies raise capital for their businesses across debt, equity, structured products, and IPOs. And with the knowledge of debt and equity, I transitioned to the investment side and initially worked with an early growth private equity fund out of Dubai. And what that did was it gave me an insight into the various possibilities and where I saw the market likely to grow in India. And that finally brought me to what I consider to be my bliss point in venture. And I have been fortunate enough to partner with two brilliant and super successful partners who have been super successful in their individual careers so far. And the three of us have come together to start Cactus Partners. We've been reasonably fortunate also in our first fundraise. We've closed with about 630 crores, which is probably one of the largest funds for an emerging manager. The transition has gone well, and so far so good.
Does that help when you evaluate companies now that you're wearing the entrepreneur hat yourself versus, let's say, in your prior roles? Is there a difference?
Definitely. I think the biggest difference is that when you are working in the corporate space, you're a salaried employee, right? That orientation is a very different one to a one where you decide you want to start something, and that requires two things. One, clear determination that you're going to make it a success. So the amount of grit, perseverance, persistence that is required is very different as a mindset when you become an entrepreneur. The second thing is you have skin in the game. You're investing in that with your whatever you have, right? So a large part of our net worth goes into whatever we do. You cannot have a cavalier approach. You have to think things through. You have to deliberate it on it. You've got to create proper plans and you have to execute it. You have to have the ability to take a bird's eye view, a 35,000 feet above sea level view of what you're going to do with a vision. And then you've got to swoop down into the nitty-gritties to ensure that whatever you're planning to do, you have to implement all those things and take it to fruition.
I'm sure you would also resonate a bit more with the trials and tribulations which entrepreneurship brings. What would be the top 3 personal qualities which you look at in a founder or a founding team? Outside of the business model in that particular industry, but purely at a humane level, what are some of those attributes which would be there?
At the heart of hearts, what we look for in founders, one, a track record. We as a fund invest in companies at a product market fit and beyond stage. Cactus Partners does not invest in seed level or pre-seed level or pre-series A levels. We typically at series A where product market fit needs to have been established, and we then evaluate that and we provide scale capital to help the founders in their growth journey. Industry parlance, you have 0 to 1 and then you have the 1 to 10. We are 1 to 10 players. Now, given that background, when we look at partnering with founders, what we try and evaluate is, one, what has been the track record? What have they done? And how relevant is it to what they're doing in this venture? Right? Because there's a lot of learning that comes from what you have done earlier, which you can bring to bear in your venture, right? So that relevance is very important, and the track record. The second thing that we look at is how much skin in the game do you have? Because if you are all in, it's only then that you know that you're going to definitely put in nothing less than the best of what you're doing. That's second. Third, we want founders who, in our minds, have done a fair bit of introspection, who know what their strengths are, where the skills gaps exist, and are willing to fill those gaps with other resources. The fourth thing is a sense of humility. We want to partner with founders who we think are open to listening, learning, and implementing. We believe that whatever your track record and historically whatever you've done, it doesn't always translate time and time again into successes. We've seen founders who've failed and then finally succeeded. We've seen founders who've succeeded in their previous businesses but who have failed subsequently. What you require a certain set of characters, and that is humility, the ability to learn and listen, the ability to sift through. We get a lot of inputs, we get a lot of guidance, we get a lot of coaching, mentoring, whatever. You need to have the ability to what you think will work best for you and implement that to succeed.
What you said, I would say, would also be a lot valid for any kind of startup. On a personal note, seen across many successful bootstrap founders.
As entrepreneurs and founders, you will have your good days and you'll have terrible days. Don't let the terrible days dissuade you from pushing ahead, and don't let the successes go to your head. Celebrate them, enjoy them, but don't let them go to your head. Right? Hubris is the biggest enemy of an entrepreneur.
Yeah, I mean, the world is littered with cases of companies which have grown and then suddenly vanished. The other thing which I wanted to kind of talk a bit about, which is a kind of a topic close to also my heart, is that over the last 5-7 years, entrepreneurship has kind of got so closely linked with VC funding, or external funding is the only way to create successful, scalable startups. How true is that?
Like I said earlier, there is no one formula. I know from the venture industry and getting funding looks very hunky-dory, but it is not so. It all depends on several factors. What is the entrepreneur's objective? And if you've done enough introspection, you will then know what is the kind of effort and scale you're looking to build in your business. business. There could be some businesses which you want to keep as a lifestyle business, right? That lifestyle business need not need funding, but the opportunity to create a global business, for example. You feel that, okay, you can take a business that is first build it out in India and then take it global. And that is the kind of vision you have or the aspirations you have. That is where funding might be helpful and useful to you. It's not necessary. I'll give you an example of my partner, Anurag. Prior to founding Cactus Partners with Amit, my third partner, and me, used to be an entrepreneur. And he has been a super successful entrepreneur. And he's built a business over 20 years fully bootstrapped. So he created a scientific communications company and over the last 20 years, they've crossed $100 million in top line, 25% EBITDA margin, 6 offices globally. The business has a B2B element where they work with big pharma. There is a B2C element where they work with academia globally. Gig force element where they work with freelancers. 3,000 out of 4,000 plus employees are freelancers. Over the years, he has worked with emerging technology to make sure that he's at the forefront of whatever business is doing. And he's run it professionally. So his brother and he started the business. They built it up over the years. They brought in the C-suite. So they brought the CFO, the chief strategy officer, the business officer, etc., HR officer, put in a second rung of CXO level. It's now running on autopilot in that sense. His brother is now the CEO and Anurag has stepped down to build Cactus Partners along with Amit and me. But you can see that he has succeeded in building a business in 20 years without any external capital. So it's not a necessary condition that you have to take an external capital to build a business. But if you see what he had grit, determination in a niche, it was a new area. It's scientific communications, right? Who had imagined that the scientific industry would need journals, white papers, all of that to be published. So it's a publishing business within that space. If you want to build a business, you have to first understand a need, a pain point, or a market gap which you can fill, and then get some idea of how large is it going to be. And then the next step is, how do you want to grow within that? Do you want to remain a niche consulting outfit, or do you want to create scale for which the approach will be very different? So it all depends on the founder and what their aspirations are.
What I sense from this is that this decision is not an either or decision, which the entrepreneur can evaluate every few years as the company grows, depending on where his vision board is. The need would be there or not. So in other words, for my audience, I would say that funding is a means to an end and not an end in itself.
Very well put. So for example, maybe over the last 7 years, the youngsters who gotten out of college, they don't have capital, but they have a big idea and they have vision and they want to create a business. There they go to seed stage investors immediately and take capital. That is a different journey. There could be others who say, okay, let me start something because I have some capital. With that capital, you start a business. You then decide whether you want to go straight away into Series A. There could be a third scenario which we've seen prior to the onset of the venture industry growing in India, where people would spend a good 15, 20 years building something gradually with maybe say a 15, 20% growth per annum kind of a thing over 15, 20 years, and then they go straight to a private equity stage. This is just terminology of at what stage you are taking money, but you're taking external capital to build your business. Why would you need external capital? It's primarily because you feel that the market opportunity out there is so large. For you to be able to tap it and build a dominant position, you cannot achieve that through your internal accruals. So it's a question of, do you want to scale from, suppose you're at 100 and you want to go to a 500. Do you want to achieve that within 10 years or do you want to achieve that in 5 years? Right? So those considerations determine whether you need to or you should take external capital or not.
What I see from what you've said is, apart from the visiting of this decision every few years, the other thing which I picked up from your response was that most of niche based businesses where the profit margins are good, where you can generate the internal accruals to fund that business growth again, are businesses where there is possibility of creating sizable bootstrap business before you look at a private equity component or a late stage VC component. If you are more of a generic player where, you're one of the many, the margins are tight, then usually you will be struggling in your day-to-day challenges, and internal accruals may not be sufficient for you to kind of, create that growth capital which the company would need. Kind of, shifting hats a bit here. We hear often stories, frustrations also of founders, of the frequent pivots which happen in VC funded or external funded companies, because ultimately there is a certain pressure, returns have to be given to your LPs, the investors. My question to you is twofold. One, how should companies look at pivots, especially even for a bootstrap startup? How do you view pivots within your portfolio companies? That's one. And secondly, is there another side to the story than just giving the investors a bad rap, just that they're forcing companies down to pivots which don't allow a company to mature enough before pivoting?
Let me take the second one first. So see, what is a pivot? A pivot is typically when you start something and you're going down a certain direction, you realize that it's not working. What can I do to make the most out of my current situation? So you rethink, given the knowledge that I have gained in this journey between where we were to where we are now, and we're realizing it's not working, but in this journey we have learned that if we do things a slightly different way, it is likely to work. That's your learning, right? And that is why you decide, let us pivot. From an investor's perspective, if something is not working and there are no alternatives, then they shut that business down. But a pivot is basically an option that says that, look, now we've done this, we've learned from it, and now we are in a position to do something slightly different. So if you were going northwards, you'll probably then shift a little and go, say, northeastwards or northwestwards. So that's a pivot. The other aspect to this is course correction. Course correction is, so if you're going in this direction, instead of going straight, you're going a little left, you're going a little right, but in the same direction. A pivot is not necessarily a bad thing. There could be a reason why you're doing a pivot that can be questioned. If, for example, you do the pivot and it works, you get vindicated. If you do the pivot and it still doesn't work, then there are various other reasons or factors where you realize why it didn't work, right? It could be that not enough thought went into it. Maybe it was a half-baked idea. They didn't even evaluate it well enough. Maybe the implementation was an issue, or maybe the sands shifted under your feet. The third possibility of the pivot could be that, sometimes people say that, look, we've already put in so much money. There is some cash left because you already put that money in. Use that cash to try this new thing. If it works, great. If it doesn't, we were anyway doomed to, shut that. That is broadly the answer to the second question about pivots. There's nothing really negative about it. It all depends on case to case. Where we are concerned, because we come in at post PMF. PMF basically is you need to have at least a clutch of investors. You need to have high gross margins because your customer likes the product and is willing to pay for it. If they are not willing to pay for it, you don't have PMF, right? So the product and the customer, the market, the fit is, there is a match and they're willing to pay for it, right? We evaluate that. If they're renewing, it means they like the product. And the fact that they're renewing at the price they are paying you, where you're getting high gross margins, means that you don't have established PMF. So if you have high margins, it's only then will you be able to move towards EBITDA profitability. So for us, we rarely see scenarios, or I hope we don't see any scenarios where we'll need to pivot. Okay, we might need to do a little bit of course correction. That's it.
Product market fit, that's often probably least understood, which is usually there. And What do you feel, or especially bootstrap entrepreneurs, because in your case, your portfolio companies have already achieved that before you invest in them. But for, let's say, an entrepreneur who's just starting up for the first 2-3 years of his startup's life cycle.
So see, the key thing that an entrepreneur needs to look at, what is the market opportunity? You're looking at a certain business, there's a certain market scale, what we call TAM, total addressable market, TAM. Within the TAM could be a very, very large number where there are lots of possibilities. But within that, you will have what is called a serviceable obtainable market. So that if I build a business, how much can I get out of this total TAM? Right? So you have to do that evaluation, step one. The second thing is identify your target group, right? Because see, there are so many consumers out there of your potential product, whatever you're manufacturing. You need to know what your product is, what is the problem you're trying to solve with that product, which ab initio tells you that there is a requirement for this product that I'm going to manufacture. The first thing you do is you identify the problem area, the pain point. Then you build to solve that problem, right? Now, when you build to solve that problem, you're putting all your efforts into product development. But the important thing to do is to say, who are you going to be selling it to? Who is your target group? And that target group is determined by what we think. There are two elements. One is the ability to pay, and the second is the intent to pay. These two things are critical. There could be a scenario where someone has the ability to pay, but they will not buy your product. They have no intent. There could be scenarios where people want your product, but they don't have the ability. I mean, Louis Vuitton, everyone wants. But do they have the ability? No, right? But you have to be able to then identify what is your TG, your target group. Find out how large that target group is, given what you're looking to do and the product you're going to manufacture, the service you're going to offer, and see that it is reasonably sizable. Then you're also going to try and find out how many other players are trying to work in that same industry. If you do that evaluation, you then know the competitive intensity of that industry. You know how you are potentially placed relative to other players. Then you know what are you doing which is potentially different from what exists in the market and why the target group would want to buy your product or your service. That entire analysis has to happen, but the thing which a lot of people miss out when they're doing their evaluation of PMF is the ability and intent to pay. If you can give that adequate thought and do enough evaluation and research, back it up with numbers, right? Numbers always give you more insight than just a gut feel.
Very well said. I mean, in terms of especially looking at the market metrics, as you go along. So, in fact, that brings me to the next question. We hear so much about India growing like a very robust 6-7% rate and a lot of opportunities opening up. I have a very simple parameter that when I go to any of these social engagements or parties, right, how often bullish people are, and often now you've seen the last 2 years, it's hard to find someone who's pessimistic. In all of this, what are some of those sectors which you really think where opportunities can arise for bootstrap startups or people who are looking at creating something?
The ecosystem has evolved very fast over the last 5 years, right? Yeah. Especially the venture side of things. It has brought in a very different mindset to the entrepreneurial ecosystem as well, where they've given the hope that if you have a good business idea, capital will not be a constraint. So earlier what used to happen is that the only option for capital was debt. So you would go to the bank, show collateral, which many of them didn't have. Today, that is no longer a constraint. It's the quality of your business idea, business plan, and your track record of what you've achieved. So you see a lot of professionals who have spent a good 15-20 years in corporate India, now starting up also, right, in the mid-40s to late 40s and so on. I think that there are opportunities across sectors. Having said that, yes, there are some sectors that have historically been in favor. Others have fallen out of favor. So for example, in the longer, you can say, finance, right? Fintech has been there, consumer, e-commerce. infrastructure, IT, for example, health, they've all been, long cycle investor interest sectors.
Yeah.
You had many short cycle sectors also, such as, say, media. Media didn't last very long, right? Prop tech, travel tech, right? So these are some of the sectors which have not lasted very long. So while there have been opportunities, right? So people have done great stuff, made fantastic businesses, but there have been cycles. Where we are concerned, what we see as potential, and which is why we are focusing in three broad sectors at Cactus Partners. One is clean climate tech. So clean climate tech is an inevitability. You have no option. Look at the status of the planet we live in. Clean climate technology is something that is a necessity. It's an imperative. That's one. And it is unlikely to have short cycles. The second thing that we have selected as a sector where we think there's going to be a long secular trend and very unlikely to have short cycles is health. As long as there are human beings, the health is a necessity. It's a perennial need. And the third thing that we do is enterprise software. We feel enterprise software is still the tip of the iceberg. SaaS as a pricing model is something that many corporates had not historically used. Almost everything is now cloud first. We feel that in India, we have the competitive advantage in terms of the talent and the quality of product development that is happening, which is global in nature. Our view is that these three sectors that we see long cycle secular trends.
SaaS, I've often heard that it's difficult to monetize SaaS offerings at scale within India. Do you think that's changing now?
Yes, significantly. So as I mentioned earlier, what was the challenge? When you wanted to implement technology, you would have to invest crazy amounts in servers, in hardware, in putting systems in place, systems integration. So it used to be a capex heavy requirement. IT used to be capex heavy. But today, it is not as capex heavy because you've got the likes of AWS, Azure, etc. providing you with the infrastructure. Today, even say the software that we use on our laptops, all of that is cloud enabled.
Yeah.
Right? And at one point of time, you had to buy a license for it for a full year, right? And pay that amount upfront. Here, you can decide when you want to use it, when you want to switch it off.
I had a couple of other pointers which I wanted to touch upon. One, entrepreneurship and investments both are very stress-filled, very rigorous lifestyles, working hours. So there's a lot of pressure as you kind of run your businesses. How do you maintain that balance between what the profession demands and what your personal well-being requires or what your family requires?
My wife and I, during our children's growing years, we took a slightly slower track in our careers because we wanted to spend time with the children, wanted to watch them grow, we wanted to spend time with them, right? So we did that. Now my children are grown up. My daughter is about to finish school. My son is going to college. They're practically flown the nest. My wife and I now have the time and the energy to do stuff. But the timing has worked very well that we've started Cactus Partners. Frankly, over the last 2 to 3 years, all three of us, Anurag, Amit and I, have really just single-minded devotion, just gone at it. It's not over yet. It's still ongoing because, that was just the initial bit where we raised the capital. Now we've got to deploy the capital thoughtfully and with discipline. You need to tell yourself this is a marathon, and so do not lose track of what you need to do to recharge also.
Right.
Otherwise you'll burn out. Quite often people make it a sprint. If you make it a sprint, you'll burn out. You know it's a marathon, so do what you need to do, but make it like a long-term thing at the back of your mind. The leisure side of things, the time, what you do, there's a slight difference from what used to be earlier to what it is now. Earlier, I could do things which required time and attention, where, for example, I started learning how to play the guitar very late in the day. But today, I can't do it because it takes a lot of effort. And with the kind of intensive days that we have, it's no longer therapeutic. So what I want to do is pick up something that comes easy and is therapeutic. So I'll cook. And because we read so much, right? We are always analyzing, always evaluating, always scouting. There's a lot of reading that happens, work-related reading that happens during the day. So after work hours in the evening, to relax, I watch a movie.
Big business leaders. I can't name them here, but they are like, very big movie fans. So you are in good august company there. I think with this, maybe any last parting words for our listeners?
In keeping with the theme, bootstrapping versus raising capital, I think there are pros and cons to both. If you're bootstrapped, the pros are that you're not answerable to anyone, right? You can decide the direction, the strategy, the pace of the business. You can decide what the profitability is, what the scale is, right? You can decide whether you want to maintain a lifestyle business or you want to, create a large organization. That's up to you. But the con there again, like we discussed, is, you will not be able to grow very fast if you want to do that, right? Because you'll have lack of capital. Your internal accruals might not be adequate. You might not be able to get debt or something to supplement because you need to show equity for your debt equity ratios to be balanced. But on the other hand, if you have aspirations and you want to grow, the pros over there are you get capital. The second thing which always helps a lot is access and resources to support your growth journey, because your investor partner wants you to succeed, and so they will help you with resources, networks, opening doors, all of that, right? So that helps you. The cons, of course, are that it's a responsibility. You've taken money from an investor, you are answerable to them. No longer can you take decisions unilaterally, responsible to the board. Decisions are deliberated. On the basis of that, you then realize you learn a lot also, right? So if you have that open mind and you want to learn, I would say that if your business has the ability, please take capital, because that will help and support the entrepreneur in that growth journey. But then also you have a lot of systems, policies, governance, etc. So that is one. And the last thing I would say is, when you're trying to grow a business, the key thing that you should do is don't try to go it alone. It's a lonely journey. Find a complementary partner, a co-founder or a partner. You have your strengths, you have your weaknesses. Find somebody who complements you, and then you all can play off each other. Not just this, create a second rung of trusted lieutenants, because it makes your life easier. That balance that you talk about in work and life will come only if you know that you have trusted people who are doing a lot of the work that otherwise falls on your shoulders. And then what you need to do is just go out and network like crazy. So those are my last words on.
Great. So I think it's been an enriching conversation, enriching the true sense of the term, different facets covered, and each of those facets can be a podcast in themselves. Product market fit, bootstrap versus VC funding, what kind of entrepreneurial mindset or skills would you need to create a scalable business? So variety of facets there. I am sure our audience and our listeners have got a lot of takeaways. And so thank you again, Rajeev, for doing this, and wishing you all the best for your next leg of your entrepreneurial journey under Cactus Partners. And for our audience, if you've liked what you heard, do click on the bell button and subscribe. We have some great content coming your way, right from people who have done it. Until then, keep learning, keep pushing the boundaries, and keep building your dreams. Adios. Thank you.